Hello everyone, I'm Ted Oakley, Managing Partner here at Oxbow Advisors, and I am so excited to have Danielle Dimartino Booth back again. And she has agreed to do a great interview with us today. She is CEO and Chief Strategist at the Quill Intelligence, and you'll be seeing a streamer if you want to take any of that service. And I'd also recommend you to get her book called Fed Up. It's the best book I ever read about the Fed. I think you'll enjoy it too. But Danielle, welcome back.
It's amazing to be here. Thanks for having me.
Yeah. So Danielle, just to kick it off, tell us, we know what the Fed's been saying, but what do you think they're really thinking?
I think that right now, Jay Powell and others at the Fed are hoping to thread the narrowest needle of all time. There are so many factors after 40 years that are pointing to inflation, even though their models and history of the last 4 decades, everything else suggests that with 18 plus million Americans collecting unemployment benefits, there should be, by the time we get through all these transitory influences on inflation, once we get through that, there should be a disinflationary pull from permanent unemployment being at the same level that it was last time we saw during the great financial crisis. And that is a number that has been increasing relentlessly month after month. So they're hoping that we can get past this episode. The problem is, my good friend Liz Ann Saunders, as she pointed out this morning, we've had a 7-8 week run up in yields. If the persistence and if I said, as I said today, if the delta, if the change is attained quickly enough, you can still send shockwaves through the market, even if it's just an inflation scare.
And let me ask you something, because when you're listening to Jay Powell, he has a sense of arrogance almost that, hey, we got this covered. And the 2 T's he uses all the time are tools and transitory. It sounds like, hey, we've got all the tools, we've got you covered. That can't be that far in front of everybody.
They can't be, but it's never not worked. The flip side of it is I did a comparison of Bitcoin of all things, and I'm no cryptocurrency aficionado, but I compared Bitcoin to negative yielding sovereign debt. One is kind of displaced the other, but the relationship broke down after the blue wave in the Senate and after those 2 Georgia Senate elections. And that's where the arrogance, in my view, Jay Powell's arrogance, might be misplaced. If they can pass another $3 or $4 trillion, and the possibility is there, if they can make this level of fiscal spending persist, he doesn't have anything in his toolbox to address that. Nothing. And that's what they don't quite understand, is that the Fed has been the only game in town for so long in terms of providing stimulus. But now you've got this double-barreled fiscal monetary approach, and that's a game changer.
Yeah, and they actually, I'm curious about what you think about this, because in the 1.9 trillion, I don't think that some of the money got where it should go, but a lot of money never gets where it should get to.
No, look, I've been great friends with Michael Hartnett at Bank of America. For anybody who's clients of the bank, his Flow show every Thursday afternoon is probably the best go-to weekly feature on Wall Street. And to see the largest weekly inflow to equity funds in the history of mankind should tell somebody on Capitol Hill that a lot of that stimulus money, we're talking about the largest weekly inflow ever into equity funds. Clearly, a lot of that $1,400 stimulus check went straight into Robinhood accounts, equity accounts. And that's whether you're looking at TSA throughput, whether you're listening to the CEOs of the airlines, or if you're listening to Marriott Corporation, you're seeing prices of services go up. Americans are like, Uncle Sam just covered spring break. And they're splashing out on travel spending, and they're putting money into the stock market, and it's patently apparent that a ton of this 1.9 trillion went to the wrong place.
Well, it's interesting because I was listening to 2 people unloading, of all things, at a fruit stand in Florida, and one of them said, I haven't decided what to do with the money. I've never been to St. John. I think I'm going to go to St. John. The other guy said, for me, it's just going to be plane tickets and beer. And so, that sort of spells that out a little bit, I think.
So I'm going to share with you one very quick anecdote. Somebody who I've worked with for years, she and her husband did not lose their jobs throughout COVID. They made just at the 150,000 mark that would have cut them off. And, she said that the first two stimulus payments, they shored up their accounts. They put some money aside for a rainy day fund, she said, but she had been on TikTok, and that this next check that her family was going to get for $10,000, because they have a certain number of children, that this next check she had learned on TikTok how to trade stocks. And so she was finally going to be able to take the plunge and help her family start retirement planning by having learned about equity trading on TikTok. And I just sat there horrified. But it is what it is.
So let me ask you, you have a slide here on basically housing and what you think about. What do you think about? And obviously, our residential housing market's been on fire, but your thoughts on that?
So there was one source of fundamental support for housing headed into the pandemic, and that's that people wanted to get out of densely populated urban centers. So you had this massive flight of people with means, and they've pushed up home prices. Ivy Zellman, a good friend of mine, she has a statistics that's long running. And normally you get 12% of relocators into any given market, and that's pushing 24% right now. So you're having a ton of people who are fairly price agnostic. They go to Austin, Texas. They go to Boise, Idaho. They've sold their home in California. And as far as they're concerned, it's a buy one, get one free sale. They're like, well, gosh, I'm just going to knock these two houses down and build myself into, I'm still up in terms of what I sold, the proceeds I got from California. That's a very fundamental source of demand that we've seen. Once America gets to travel again, that source of demand is going to dissipate. But then you've got Jay Powell and his merry band buying up a third of the mortgage-backed securities market, pushing mortgage rates to all-time lows. And on top of that, the spread between the 30-year fixed-rate mortgage and the 10-year yield is still such that a lot of mortgage lenders have wiggle room to not pass along all of the increase that you've seen in the 10-year yield. And you have Fannie Mae and Freddie Mac doing automated appraisal waivers to where you don't actually have to have a human being inside the home in order to get the Fannie and Freddie mortgage or get the Fannie and Freddie refinancing, such that cash out refinancings were running at $100 billion per quarter towards the end of last year. So you have a ton of public policy that is fed into this machine. And then you have this rational source of people escaping the cities. But something is definitely poised to break. And you can sense that in
ask you, how does that relate to multifamily apartment business? I mean, how do you see that?
So the supply of multifamily coming online in the United States in the next 2-3 years is unprecedented, and it is all contingent upon the assumption that the millennials are going to continue to reside in these high-end apartments when the millennials have decided to wander out to the exurbs and procreate. So there's a supply-demand mismatch. And so many of the properties were high rises in urban centers. There was a second assumption that because 70 was the new 60, and because once you've replaced all your hips and your knees, a lot of the boomers were anticipated to come into urban centers and want to live city life. That's also been flipped on its head. And now what we see with the census data is that we have more multi-generational families forming in the United States than we've ever had. You've got multiple generations underneath one roof. That is not what the multifamily developers envisioned. They thought that they were going to have hip boomers and hip millennials filling up these apartments, and they're not.
Well, and what I've been trying to do in this interview is really catch all of the things that the easy money has affected. That's obviously one of them. The second one, and I think you would agree with me, there's so much leverage in everything today. Everything is leveraged, and I think there's one big problem we have. It's leverage. And talk about the leverage. You've got a slide about how equity really is masking, what's happening on the leverage. Because the equity is so high, it looks like debt to equity is not it's okay, but really the equity is out of line.
Exactly. It is exactly the equities that's out of line. When you're hearing in the same week and reading the same headlines, AMC may go bankrupt, but by the way, AMC is selling equity because, the Reddit chat room, GameStop, Robinhooders are playing AMC. AMC was smart, by the way, to sell that equity. But when you're seeing these things play out, American Airlines, which is probably a somewhat insolvent company, now has $50 billion of debt on its balance sheet. So one of the largest debtor in tattered balance sheets in the nation. And yet the bond market has been open. Morgan Stanley does some really fascinating math. You've got this slide. At the end of the third quarter of 2019, the analyst said that had the rating agencies been honest in their appraisals of companies' balance sheets, that 38% of the investment grade bond universe should have been rated junk. Now, fast forward to Jay Powell's grand plan and bailing out the corporate bond market on March the 23rd, 2020. 1 year later, 54%. See, the 54% 1 year later at Q3 2020 should have been rated junk had they been rated properly. So there's a massive over-indebted overhang in corporate America.
And that's not counting, and it's in that same slide you have here that we're showing all of the triple B, BAA debt. That's right on the verge too. I know they say that portion of it, but they may be more than that.
That's exactly right. Again, the slide that you're going to share is timestamp Q3 2020. So that doesn't even get us to, we know that we've just had the second most robust high issuance first quarters in the history of the bond market. So
taking that leverage a little bit further, you have a slide of the CAPE ratio, which for for everyone out there, that's a cyclically adjusted PE, but it's so some people watching this don't know what the CAPE is, but you have a great slide on the CAPE ratio that goes way back, and you might talk about that as well.
So there was all this talk around New Year's about the Roaring '20s and how we were at the advent of another decade of, we're going to see a run up to 1920. So look back at the cyclically adjusted price to earnings ratio. Back a century ago, that price to earnings ratio was around 5. And at the lowest level on record. And so you would think intuitively, wow, if stocks were that cheap, of course they were on the precipice of the roaring '20s. You look to where we were at the beginning of this year with all the chatter about the next roaring '20s, and the PE was 7 times that level. And it's continued to rise since then into the first quarter. And people need to understand that starting points matter. And this is not a launch point from which to see an extended run in the stock market, given the fact that you get what you pay for, and you're paying 7 times what you paid for back in December 1920, as opposed to December 2020.
And you have this slide also that shows how that leverage and the free money really has gone into the small investor side. And what are your thoughts on that?
So, I think that a lot of people on Wall Street in 2017 were saying, well, the VIX, the volatility on the stock market, the VIX index closed at a record 52 times south of 10 in 2017. So the prior record was like 1994 and 4 or 5 instances of the VIX being below 10, and then that single. And so going into 2018, we were all like, well, this is just a sea of complacency. But what was missing? We were complacent and stocks were rich, but there was no retail participation. And, the smart money argument always says that until you have retail participation, you really cannot see the end of a cycle. That the difference between then and now is that now retail participation is north of 20%. So, on top of that, you have the SPACs, and you have the cryptocurrencies, and you have IPOs of worthless companies. All of this is indicative of something that was much more endemic in 1999, 2000. And retail participation is absolutely essential for you to be able to say, we might be finally coming to the end of this.
And retail, or in Main Street, individual investors, What happens is, and I know you've heard the same thing, everywhere I go, I have someone telling me, my sophomore in high school or my freshman in college, they're really in the market now. They're really doing it. I always think to myself, interesting, they've probably never been through a bear market.
Well, you know what, Ted, it's funny that you say that because most people in the business have never been through a bear market in bonds. And so that's my biggest touchstone these days, is that everybody is assuming that we're going to revert to the mean of the past 40 years of a falling interest rate environment. And I want to say falling from where to where. But it is the shoe shine analogy from the 1920s when the shoe shine boy was interested in the next hot stock. It is the 1998, 1999 when I lived in New York and you couldn't take a taxi cab ride without the taxi cab driver asking, what's the next hot IPO that's coming. So there's always these signposts. And my stock answer when somebody tells me, my kid in high school, I'm like, this is going to be a great learning experience. This is going to be fun. They're young enough to lose your money. So this is great.
Well, and I will say that I have been in an inflationary market, and that tells you where I've been.
I wasn't going to say that.
I know you weren't going to say it, but having said that, it's interesting to me that the average portfolio manager today is about 48 years old, so they don't have a clue as what it's like to buy a bond, and then every 3 months it goes down, and so in price. And I think that's one of the things, most bond funds are down for the year right now. People, I think, will be surprised when they get their quarterlies about what's happening there. But it is interesting that comes about. But, in all of this stock market and leverage and residential and everything, you have a slide here, and this is something that really I'm sensitive to because it's bothersome to me. It's who's left out of all of this. You've got an educational slide. I think our problem is we've just blown the middle class out, and so we have a problem.
The inflation that is going to be, I think, most harmful to the country is the inflation you're going to need in your in your higher education. If there's anything that COVID has taught a lot of the biggest employers, it's that if I was on the fence about automating, I better push forward. So it's going to accelerate this push into automation to where your kids' undergraduate degree is not going to get them in terms of a lifetime of earnings what it once did, and they're going to have that graduate degree or more in order to get the same income expectations over their lifetime career. And that's really a sad reflection. Again, there were winners and losers who were chosen by the Fed and chosen by the federal government at the advent of COVID, and the hollowing out of the middle class is going to be probably the most devastating after effect of the choices that were made.
And I saw some numbers last week that said that 66% of people with student loans right now, they're in school, are delaying paying them back until they see what's going to happen with this next bill.
It is moral hazard wrought large. I went through the math of what a single working mother with one child between the age of 0 and 7 and one child between the age of 7 and 18, with the child care tax credits being deposited monthly, with her rent being covered, with her Obamacare health premium being covered, or up to 100% of your COBRA payments if you were taking COBRA. I went through the math without any of the stimulus checks and just looked at what her income was on an annualized basis, $60,912. You will not get this person to agree to willingly come back into the workforce, which means that you're going to be looking to Janet Yellen increasingly in the future to maintain this level of income for the people who choose to not work.
And it's interesting because back in the Depression, we had all of the works projects, and so you got paid, but you were doing something. You were doing something, infrastructure, building roads, dams, everything. And now we're just paid to stay home. That's what we're doing at this point.
I think infrastructure spending is, and that's the tragedy of Joe Biden, is that he had more than any president in modern history. He could have been the next coming of FDR. He could have been. And when you think of all of the oil and gas workers who've been displaced, whose skills are fairly transferable and what have you, to rebuilding out the nation's infrastructure, but making them actually work. And now you are indoctrinating a generation of workers who even given the incentive, you have to ask the question if they would even take the work. And that is not the American way at all.
So, there's the next slide is a slide of the 30-year Treasury from October 31, 1981, the high, until now, and it's obviously turned up a little bit right now. I guess my question to you, nobody knows this, but I just your opinion on whether you think we've seen the end of that bond bull market?
So again, I am a broken record. I think it comes down to the consistency with which we can expect further fiscal spending that the Fed effectively monetizes. And the problem right now is that China is very much, China likes the idea of the inflation scare being drawn out. They don't mind the fact that shipping has been delayed as much as it is, that input costs are as high as they are. But now you're going to have services inflation come on top of the input inflation that we know are squeezing manufacturers. My husband's in industrial packaging, and he's never seen this many price hikes in his 30-year career come in such short succession. So you have the persistence on the manufacturing side. You have services inflation that is picking up rapidly. And you have Jay Powell over here looking like he's literally been on the golf course at Chevy Chase all day long saying it's going to pass and it's going to pass quickly. And Janet Yellen saying, and by the way, most of Congress saying that they can label $3-4 trillion more fiscal spending. They can label it as being COVID relief and pass it with reconciliation. So if that's the case, you don't even have to talk about whether Joe Manchin is actually, you do have to talk about Joe Manchin being the most powerful individual in the United States of America, because he would be the only line that would be preventing that 50-50 vote from occurring. But if my Beltway contacts are correct, we could see a continuation of these inflationary pressures. One of the best slides I've seen was out on Twitter yesterday. It took 15 years from the 1960s up until 1980 for this inflationary wave to build. But that's the thing. If you have the persistence and the build, we could be looking and finally saying goodbye to this 40-year cycle.
Well, and also in that same period you talked about, inflation was always running a little higher than the interest rate. So in that respect, I think that's the only way you would ever get out of this debt. I don't know. If you look at it, you're going to have something that changes that.
You are, but by the same token, the rate at which the Chinese currency is appreciating in value suggests that they're not going to sit around with popcorn and wait and see what the end of the movie is going to be. And that is something that so few are factoring into their calculus. It's that COVID not only shaved 2 years off of the expected time frame for the Chinese economy to become larger than that of the United States from 2030 to 2028. But if their currency continues to appreciate based on our debt build, then it could be as soon as 2026. And that means that we've run out of options in terms of inflating our way out of debt.
So let me ask you this. I looked last week, for example, we had, I think, 24, 25 IPOs, over half of which were SPACs, and then we had 24 secondaries. Wall Street is really taking advantage of Jay Powell right here, and they're throwing everything they can out to the public. Any thoughts on that?
I'm always I marvel on whenever the financials start to reporting and the analysts are like, wow, look at all that trading revenue and look at those investment banking fees, and I'm like, well, of course, you've got both corporate debt and equity and M&A going at the most fevered pace. There's no way, if Goldman Sachs or Morgan Stanley or JP Morgan was to disappoint, something would be truly wrong, because the Federal Reserve has handed them so much income on a silver platter, and you've got all this retail participation at the same time. So you've got the velocity, you've got trading volumes also having gone up. This is bought and paid for by the Federal Reserve.
So with that, Danielle, let's say, this is the problem today. If you look at serious investors that were, say, more conservative, that prior to the last 15 or 20 years, they put their money in CDs in the bank, and they buy treasuries. They'd save money and get paid for saving it. You don't get paid for saving it anymore. And I don't think people watching this realize, but today, the 1 month and the 3 month are negative on the treasury. I'm certain people are not aware of that, don't you think?
To see Jay Powell struggling to fight the yield curve at both ends is truly remarkable. You have, Steve Mnuchin left the Treasury General account, which is the United States checking account held at the Federal Reserve. Steve Mnuchin left office with about 1.7 trillion or so of a balance in that United States checking account. That's being run down, which is building up reserves in the system. And it's being run down because all these stimulus checks are being written finally, and because income tax refunds are going to also get spent. So all of this cash is flooding into the system. At the same time, the Fed is buying $120 billion a month through its quantitative easing program. Banks are choking on reserves. They're rejecting deposits. And so you've got money market funds right now rushing to try and find any kind of positive yielding debt, which has pushed the shortest term Treasury bills into negative territory. Mnuchin would know what to do right now. Janet Yellen does not. When we had this issue before, Mnuchin ran out and issued more Treasury bills to satisfy this lack of collateral. That's not happening right now because most of the beginning of this $1.9 trillion is being paid for in money that the government issued last year. So we have a serious issue at the shortest end of the curve right now. And that's one of the reasons that the Federal Reserve did some very quiet tinkering with the facility that money market funds can tap into that allows them to find some kind of yield. At the last FOMC meeting, the Fed raised that cap from 30 billion per counterparty to 80 billion per counterparty to try and alleviate some of this stress. Because the last thing they want to do is say that we're not even thinking about raising interest rates. Oh, but by the way, we raised the shortest terms one. So but it's not tightening though.
So with that, if you look, and I've mentioned this before in some other recordings I've done, but I've said that if you look at the Wall Street mantra of 60-40, 60% stock, 40% bonds over the last many years, at least 10 years, it's worked well for them and everything. But my contention now is that there is no 40 because you don't get enough yield to make that work. And if you inflate at all, you're going to lose money on that 40 side. But if you were advising somebody today, what would with money, they've just come into money or whatever, where would you head with it?
Oh gosh, I mean every other week I wake up and I'm like, oh, please don't let one of my municipal bonds get called, because there are so few places that you can find a harbor from the storm in this kind of an environment. Again, even if I think that the 30-year is kind of interesting right now on an interim play. I really do, just because I think it's gone too far too fast. The yield has run up too far too fast. But again, you're talking about an interim play. You're talking about something that's got a 2.4% handle. How much are you going to get out of that? But in terms of planning, this is a very, very, very difficult environment. Very difficult environment because you're not advising clients with portfolios how to go trade the market. That's not investing. That's trading. And by the same token, what we started talking about, all the leverage that's built up on corporate balance sheets. One of the safe harbors, bizarrely enough, so far this year has been high yield, because high yield has so little rollover risk. The $47 billion of high yield bonds had to be refinanced in 2021. That's a rounding error compared to the $800 billion in investment grade and the $420 billion in commercial mortgage-backed securities. Commercial real estate loans that have to be rolled over. So it is exceedingly difficult, given commercial real estate has not corrected and given residential real estate has gone off the rails, to try and say, where's your safe harbor? I'm wondering what my gold is finally going to do for me.
Well, and I think, for a new investor that just had a liquidity event or something, this is probably one of the hardest times to crank it up right here. As you know, people want to say timing doesn't matter, but it really does matter in the long run.
It matters when, when stocks are in the 99th percentile of historic valuations. It has to matter. It has to play into the calculus. So I just bite my tongue and say, buy me another muni. And that is the most boring. I mean, people are like, you've got the portfolio of a 90-year-old, Danielle. And I'm like, well, yes, but I may not be 90, but I'm certainly not willing to work a whole nother career to make up for what I lose.
Well, listen, this has really been interesting today. I know everybody will enjoy watching. You are one of the very top people that we get requests for. So I know it goes a long way. And you can see on the screen how to take the service if you want to take the Quill Intelligence service, which I would recommend to anyone. It's a great, and you're also looking at the best writer I know right now in this business is Danielle. I don't know where she got her writing skills, but I do know you worked hard because I know a little bit about your history. So, we could use that with these young people as well. But listen, Danielle, we really appreciate you being on, and we look forward to seeing you next time.
Likewise, Ted. Stay safe, stay nimble.
All right, thanks.